Suresh Jain, CFO of Essar Oil, joins us now to talk about the CDR issue. Mr. Jain, good morning. Thank you for joining us. Essar Oil has exited the CDR which was set up in 2004. What this means for the company and what kind of financial picture do you think we could be staring at now when it comes to for Essar Oil?
Thanks, Nikoj. We have come out of CDR exit at the end of the financial year. But before I touch upon the CDR exit, let me take through the key milestone the company has achieved during the last financial year. You see, company started the year with the completion of its expansion program, taking the capacity from 6.1 to 11.8 and capacity to 18 million metric ton from 10.5. The financial year ended with another significant achievement, CDR exit, which was fully completed on 30th March 2013 and which was only possible with the continued support from our lenders, and we are thankful to them. Apart from the CDR exit, company has also completed the optimization project during the financial year, 4 months ahead of the schedule, taking the capacity to 20 million metric ton, fully stabilized the operations during the financial year, switched the feedstock for its fuel and fuel from liquid fuels to the coal. GRMs which we have declared during the last 2 quarters are in line with the international benchmark. Sales tax fully settled, although it has adversely impacted the financials of the company, and Essar is the only refinery which has not got this benefit. And lastly, the credit rating of the company was enhanced by 2 notch to BBB+. Coming to CDR, we have signed the new common loan agreement with 18 lenders on 30th of March. Thereby, the master restructuring agreement, which was executed during the year 2004, has completely been replaced with the new agreement, and company is now completely out of the CDR. ICICI, IDBI, Punjab National Bank and IFCI are the key major lenders apart from some other lenders and insurance companies. This CDR exit will provide the operational and financial flexibility to the company.
So are you planning to raise some low-cost debt as well, and what is the average cost of debt right now and how do you plan to bring it down?
Aisha, your question is very correct. Going forward, the major challenge left with the company is to dollarize its balance sheet and P&L account. As you are aware, we are a dollar-based company, and we have embarked a program whereby we will convert our high-cost rupee loan with the dollar loan, which are very competitive. Today, we have average interest cost of around 12%, and which we will replace by raising foreign currency loan, and the average saving which we expect from this raising is around close to 6%, and in terms of the finance number, it will contribute close to 180 to 200 million US dollar.
So what will be the new equity base of Essar Oil after the CDR exercise? Just the numbers.
You see, in terms of the equity base, there is no change because the CDR exit is basically with the lenders, and the overall shareholdings of the promoters, including the GDS, would be around 90%.
And after the GDR conversion, the news which we got this morning, what will be the promoter holding in Essar Oil now?
Now, you see, as I told you, the equity holdings, including the when we are talking about the GDS, when we convert them, it will going to remain at 90%.
Now, what we understand, and I believe Essar Oil has informed the exchanges this morning that government, SEBI, has allowed the promoters to convert their GDR, which is Global Depository, shares. What will happen after the conversion of that is what I'm trying to gather from you.
You see, what today we have the overall, we have the total number of shares in the India, which is listed in the BSE and NSE. 10% of that is the public. But if I exclude the GDS portion, our holdings in the public is close to 30-35%. So once I convert those GDS, holdings in the overall holdings, which is currently 10%, will increase.
Okay. Let's talk about the business environment. What's happening to your GRMs for the quarter gone by? Essar Oil had reported strong GRMs, which is global refining margins.
Yeah, as I told you that the last quarter, which we reported for October, November, December, the benchmark GRM was $9.75, which is in line with the complex refinery. And I will not be able to talk about the last quarter because we are going to announce results. But I can see that last quarter the average GRM was good.
Okay.